In 1998, a group of Nobel-level minds ran a hedge fund called Long-Term Capital Management. They had models, they had prestige, they had access to cheap funding. Then Russia defaulted, spreads blew out, and the fund nearly took parts of the financial system with it. The core problem was not that they were stupid. The core problem was leverage. Leverage is borrowed money or borrowed exposure that makes each small move in price matter a lot more to your equity. It can turn a normal bad week into a career-ending drawdown. If you have ever bought a house with a mortgage, you already understand leverage. You put down a smaller amount of your own money and you control a bigger asset. That is not automatically reckless. It is a tool. The risk comes from the fact that the asset can move against you before you have time to recover. Markets do not care that you are right in the long run if you are forced to sell in the short run. Here is the simple math that most people skip. If you are unlevered and you lose 10%, you need about 11% to get back to even. If you lose 50%, you need 100% to recover. That is drawdown math. A drawdown is the peak-to-trough decline in your account value. Leverage makes drawdowns deeper and faster. It also changes your behavior. It makes you watch every tick. It makes you flinch. It makes you do the one thing that kills long-term returns: sell low to stop the pain. Leverage feels good when volatility is quiet. Volatility is how much prices wiggle around up and down day to day. Quiet markets invite people to size up. They look at the recent past and assume the future will look similar. That is recency bias, a behavioral finance term for overweighting what just happened. The problem is that leverage is most dangerous when it looks safest. When volatility is low, lenders relax, margin requirements drop, and everyone is tempted to run hotter. Then the regime shifts. A regime shift is a change in market conditions, like going from calm to panic, or from liquidity to illiquidity. Leverage does not handle regime shifts well. Let me make it concrete. Suppose you have $100,000. You buy $100,000 of an index fund. A 20% drop takes you to $80,000. It hurts, but you can hold. You are not forced out. Now suppose you use 5 times leverage. You control $500,000 of the same index exposure. A 20% drop is a $100,000 loss. That wipes out your equity. In real life, you would be stopped out by margin long before that. Margin is the broker requirement that you keep enough equity to cover losses. The margin call is not a moral judgment. It is a mechanical liquidation. It sells you out at the worst time because the broker is protecting itself, not protecting your long-term plan. This is why I talk about risk of ruin more than I talk about returns. Risk of ruin is the chance you blow up, meaning you lose so much that you cannot keep playing the game. In investing, survival is the first edge. If you survive long enough, time and compounding can work. If you do not, your future skill does not matter. A lot of people think leverage is only about borrowing cash. It is broader than that. Options are leverage. Futures are leverage. Leveraged ETFs are leveraged. Even a concentrated portfolio can behave like leverage because your effective exposure to one factor becomes huge. Factor is a driver like growth stocks, small caps, energy, or credit spreads. When one factor dominates your portfolio, your outcomes can become binary. I want you to notice something about big blow-ups. They rarely come from one bad trade. They come from a chain. High confidence, high size, crowded positioning, then a shock, then forced selling, then feedback loops. Feedback loops are reflexivity. Reflexivity is when price moves change behavior, and behavior changes price moves. In a leverage-driven sell-off, falling prices trigger margin calls force selling, selling pushes prices lower, and the cycle repeats. Fundamentals might be fine, but the plumbing breaks. Look at Barings Bank in 1995. Nick Leeson did not just make a wrong bet. The failure was also controls and incentives. Controls are the basic checks that prevent one person from hiding losses or increasing risk without oversight. Incentives are what people get rewarded for. If a trader is rewarded for short-term gains and can hide short-term losses, leverage becomes a weapon. The lesson for a normal investor is not about being a rogue trader. The lesson is that systems fail when they assume people will always act rationally, and when leverage allows small errors to become fatal. Now let us talk about the seduction of leverage. The seduction is that it seems to create skill. In a bull market, leverage makes you look like a genius. It compresses time. You see big gains quickly, and your brain anchors on those gains as normal. Anchoring is when your mind fixates on a reference point, like your recent account high. Then a normal pullback feels like an injustice. That is when people double down. Professional traders who survived for decades understood this. Paul Tudor Jones is known for focusing on defense. He talked publicly about never wanting to be in a position where he cannot act. That is liquidity risk. Liquidity risk is the risk you cannot sell when you need to, or you can only sell at terrible prices. Leverage and illiquidity are a toxic pair. You can be right and still go broke if you cannot exit. Stanley Druckenmiller has also talked about sizing and knowing when not to press. People remember big wins like betting against the British pound in 1992, which is associated with George Soros. What gets less attention is the risk management around those trades. Big macro trades are often expressed with leverage, but the survivors manage the downside. They cut risk when the market disagrees, and they respect that they can be early. Early can feel identical to wrong when you are levered. Warren Buffett is a useful contrast. Buffett uses leverage in a different way through insurance float. Float is money held from policyholders that can be invested before claims are paid. It is a form of funding. The reason it worked for him is not magic. It is that the liabilities were structured and diversified, and he kept a lot of liquidity. He also avoided situations where he could face forced selling. Charlie Munger talked about avoiding big mistakes. Leverage is a big mistake amplifier. It does not just increase returns, it increases the probability of a catastrophic path. One of the most important ideas in leverage risk is tail risk. Tail risk is the chance of extreme outcomes, the rare crashes. Leverage makes tail risk matter more because tails do not need to happen often to kill you. If you run a strategy that makes a little money most months and occasionally loses a lot, leverage will make it look smooth until it does not. That is negative convexity. Convexity is how your gains and losses change as markets move. Negative convexity means your losses accelerate when conditions get worse. Selling options without protection is a classic example. Many blow-ups are hidden short volatility positions. They collect pennies and occasionally pay dollars. With leverage, those dollars become your whole account. Another term I want you to know is correlation. Correlation is how assets move together. In calm times, correlations look low. In stress, correlations often go to 1, meaning everything falls together. That is why diversification can fail when you need it most. Diversification is holding different assets so that one loss is offset by another gain. It is real, but it has limits. If you are levered, you have less room for those limits. When the storm comes, your portfolio can behave like one big trade. This is where decision-making under uncertainty matters. Uncertainty means you cannot know the future distribution of outcomes with confidence. You can estimate, you can stress test, you can use base rates. Base rates are what usually happens in similar situations across history. The base rate for markets includes crashes, gaps, and long drawdowns. If your leverage plan only works when the base rate bad things do not happen, it is not a plan, it is a wish. I also want to bring up the Kelly criterion because people misuse it. Kelly is a formula for optimal bet size when you know your edge and the odds. In plain English, it tells you how much to bet to maximize long-run growth. The problem is that in markets, you do not know your edge precisely, and outcomes are not stable. If you overestimate your edge even a little, Kelly sizing becomes too aggressive. Half Kelly or less is often discussed because it reduces the chance of deep drawdowns. The practical point is simple. When you use leverage, you are declaring that you know the future better than you do. Most of the time, that declaration is wrong. So how do I think about leverage for a normal adult investor? I think about it as a fragile bridge. It can save time, it can increase efficiency, it can help you express a view. But the load limit matters more than the destination. The load limit is your capacity to absorb losses without forced selling, without panic, and without breaking your life. Your real leverage is not just in your brokerage account. It is in your job stability, your emergency fund, your debts, your dependents, and your sleep. Sleep is a risk metric. If leverage makes you check prices at midnight, it is already costing you. I also separate volatility from risk, but I do not ignore volatility. Volatility is not the same as risk, because an asset can be volatile and still be a good long-term hold. Risk is the chance of a bad outcome for your goals, but leverage converts volatility into risk very directly. A normal 2% daily move becomes a margin event if you are sized too large. The market does not need to crash to hurt you, it just needs to move around. If you want one mental model that stays with you, it is this. Leverage reduces your time horizon. It forces you to care about short-term marks. Marks are the current market prices of your holdings. Even if you are a long-term investor, leverage turns you into a short-term trader because your lender sets the clock. That is why so many smart people blow up. They were not wrong about value. They were wrong about path. Path is the sequence of returns.